Listen, I want you to picture a kitchen table, not a metaphor, a real one, in a quiet neighborhood in Lafayette, Louisiana. Dorothy Thibodeau is 72 years old. She's sipping her morning coffee, and she feels like she finally won the game. She spent 30 years as a school administrator, paid off her mortgage, and currently has $215,000 in a high-yield savings account. The bank pays her 4.8% interest, giving her over $10,000 in free money every year. But Dorothy is walking into a financial minefield that the IRS has been preparing for decades. What she thinks is a safe harbor for her retirement is actually the trigger for a tax bomb that will explode in 2026. Welcome to My Finance, where we expose hidden legal traps designed to confiscate your hard-earned wealth. If you think your bank is your friend because they are offering you a high interest rate, you are missing the bigger picture. Before we break down the math that is going to save your retirement, I need you to smash the like button right now. Banks and brokerage firms want this content suppressed because they thrive on your financial ignorance. Smashing that button is your way of rebelling against a system that wants to keep you uneducated and overtaxed. Now, let's look at the document Dorothy received in the mail, which turned her golden years into a nightmare. It's called the Social Security Tax Torpedo, and it relies on a specific calculation called provisional income. The IRS uses this formula: your adjusted gross income plus your tax-exempt interest plus 50% of your Social Security benefits. For Dorothy, that $10,000 in bank interest wasn't just a bonus, it was a catalyst for total wealth destruction. These tax thresholds haven't been adjusted since 1983, meaning the government is effectively stealing your purchasing power. Once Dorothy's provisional income crossed the $34,000 mark, the IRS began taxing 85% of her Social Security check. Here's the math your advisor won't tell you. Every single dollar of interest Dorothy earns makes another 85 cents of her benefits taxable. She isn't just taxed on the dollar she earned, she's taxed on $1.85. In this phase-in range, your effective tax rate on safe bank interest can skyrocket to over 46%. But the government wasn't finished with Dorothy yet, because the clock is ticking toward December 31st, 2025. That is the day the Tax Cuts and Jobs Act officially sunsets, and the old higher tax rates come roaring back. Unless Congress steps in, the 12% bracket you're using today will automatically jump to 15% in 2026. The 22% bracket Dorothy relies on will hit 25%, and the standard deduction will be nearly cut in half. This is a coordinated effort to claw back the wealth of the middle class before the next decade begins. Dorothy thought she was earning a healthy 4.8% yield on her $200,000, but after the tax torpedo and the 2026 sunset rates, her actual net gain was chopped down to a measly 2.5%. She didn't lose money in the stock market. She lost it to a system she was told to trust. She did everything right, saved her money, avoided debt, and used a high-yield account, and she is being punished for it. The system is rigged to reward the spenders and penalize the savers who have a large cash balance in the bank. If you have over $30,000 in a savings account, you are standing directly in the blast zone. But the tax bomb isn't the only trap the government has set for your cash in 2026. Wait until you see what happens when you try to move that money out of the bank to protect yourself. Why are all advisors and banks obsessed with keeping your cash in high-yield accounts? They are feeding their own lending machine. While they collect fees, the Treasury weaponizes the bank as a surveillance tool. They need your liquidity while they watch your every move through federal reporting. Under the Bank Secrecy Act, banks have become government informants. Specifically, 31 U.S.C. Section 53224 creates a legal minefield for any retiree who values their privacy. You might think withdrawing cash in smaller amounts avoids intrusive government paperwork, but this is the structuring trap the IRS and FBI wait for you to hit. It is a federal felony to break up transactions to stay under the $10,000 reporting limit. Legal money can be seized by agents immediately. This is civil asset forfeiture. The government can take your life savings without ever charging you with a crime or gaining a conviction in court. Imagine a federal agent freezing your accounts because you withdrew $9,000 twice. Your bank won't defend you. They secretly filed the report. The surveillance is only the first layer. The second layer is the Medicare IRMA surcharge, which acts as a massive hidden tax on your hard-earned financial success. The IRMA cliff is a trap you won't see coming. Just one single dollar over the income threshold triggers thousands in additional monthly Medicare Part B premium surcharges. This isn't a sliding scale like regular tax brackets. In the world of Medicare, crossing that line means you pay the entire penalty for the whole year. For 2026, the first IRMA tier starts around $108,000. Your safe bank interest could be the trigger that pushes you over that cliff. Don't forget the 2-year look-back rule. Your 2026 income determines exactly what you will pay for Medicare Part B and Part D premiums in the year 2028. Your financial advisor isn't warning you because they rarely look at your Medicare costs. They focus on assets under management because that is how they get paid. The system is rigged to keep you in high cash positions that trigger surcharges. Simultaneously, they report your cash movements to the Treasury for the smallest perceived slight. If your bank interest pushes your modified adjusted gross income $1 over the limit, you hit the cliff. There is no grace period for this mistake. The government doesn't just want your income, they want a piece of your safety net. Approved accounts make it easier for them to track and tax you. We are entering an era where liquidity is a liability without legal knowledge. Authorities count on your desire for simplicity to lead you right into a trap. A CTR is routine for transactions over $10,000, and it is perfectly legal. Attempting to sidestep that paperwork is what creates the federal felony charge. It is the ultimate irony. The more you try to protect your privacy, the more the law treats you like a criminal. Prudence has been weaponized against you. While you navigate asset forfeiture, the 2026 tax sunset is retooling brackets to take more. The 12% bracket is scheduled to jump to 15% soon. Every dollar of interest that triggered the Social Security torpedo is now taxed higher. The math is moving against you on 3 fronts at the same time. There's almost nowhere to hide your liquidity from the reach of the Social Security Administration. The system is designed to force you to spend your assets. You work too hard to let a $1 mistake or paperwork error ruin your legacy. You need a strategy that accounts for these institutional villains today. We must look at how to pivot your assets before the 2026 cliff arrives. If you do not move now, you will be caught in a surveillance tax net. Calculate your interest income ceiling before the 2026 tax hike. Banks will not help you do this math. Step 1 is your baseline income. Add up pension, dividends, and any monthly rental income you receive. Add 50% of your Social Security benefits to that pile. This is the number the IRS tracks. Step 2 is headroom. Subtract your baseline from the thresholds. $34,000 for singles or $44,000 for couples. Step 3 identifies your maximum interest. This represents the interest you can earn before your Social Security tax hits the 85% torpedo. Step 4 is the ERMA check. Measure the distance between your total income and the Medicare surcharge cliff at $106,000. Crossing that cliff by $1 means you pay the full surcharge for the year. It is a tripwire designed to punish middle-class savers. Step 5 determines your interest ceiling. Take your smallest headroom number and divide it by your current bank interest rate. If your rate is 5%, divide by 0.05. That result is the maximum cash balance you can safely hold in that high-yield account. If your balance is higher than that ceiling, you are losing money. You are effectively working for the IRS, not for your family. You have legal alternatives that the mainstream media refuses to discuss. Move that excess cash into tax-smarter vehicles now to protect your returns. Consider Treasury bills. These are exempt from state and local taxes, giving you an edge in states like California, New York, or Louisiana. Then there are municipal bonds. While federally tax-exempt, remember the interest still counts toward your provisional income for Social Security purposes. For more control, look into a multi-year guaranteed annuity. This allows you to defer interest income until you choose to realize it. By using a MyGay, you can time your income for years when your taxes are lower. You are putting a silencer on the tax torpedo. To kill the problem at the root, look at Roth conversions. Pay the tax now at lower rates to eliminate future RMDs forever. This moves your money from forever taxed to never taxed. It is the ultimate middle finger to the looming 2026 tax sunset. On December 31st, 2025, the current tax protections expire. The 12% bracket jumps to 15, and the 24% bracket hits 28. The standard deduction will be cut in half. If you wait until 2026 to move assets, you have already lost this financial battle. Do not assume your CPA will catch this. Most tax professionals are too busy processing forms to provide this level of proactive strategy. Find a fee-only fiduciary and demand a tax projection for both 2025 and 2026. See the numbers on paper before you move a single dime. The system is counting on your hesitation. It is designed to harvest the wealth of those who follow safe advice from big banks. Smash the like button now to help us fight the algorithm that suppresses this category of content. The banks want you to stay uneducated and trapped. Send this video to one homeowner you know over 65. The clock is ticking and they deserve to keep their hard-earned money. You did everything right. You saved your money, you paid off the house, and you avoided debt. Do not let them take it at the finish line. Be aware of the Bank Secrecy Act when moving large sums. Withdrawing $9,000 twice to avoid paperwork is a felony called structuring. The government can seize that money through civil asset forfeiture without a conviction. Always move your funds legally and with a clear paper trail. This is about financial survival in a rigged system. Stay accurate, stay angry, and protect what is yours. We will see you in the next one.